let's look at behavioral finance. And this is totally different from your traditional finance, which is what you are used to. Yeah, you've been taught traditional finance all of your life, especially if you remember your efficient market hypothesis that tells you that there are different types of market. There's a weak market, there's semi-strong market, and there is a strong market, which is about how investors react to information available in the stock market. Yeah. So in your traditional finance, what you expect is that investors are logical. Yeah. And what do we mean by they're logical? You expect them to take rational decision. Rational decision is what you expect. And how do they take this rational decision? You expect them to use empirical data. You expect them to use fundamentals, ratios, price earning ratios, good cash flows to decide what stock should they invest in. So you expect them to do a lot of work. You expect their decision to be based on verifiable evidence, information, data before they take decision. That is consistent with your efficient market hypothesis, information and investors' response. However, this is not what behavioral finance is all about. So this is traditional finance. However, there's a school of thought that believes that investors most times or sometimes don't even use any of this data. We have seen that investors sometimes now base their decisions on simply emotions, sometimes social factors. Yeah, or even other reasons, but not data. So when investors are using all of this, apart from the data that you are used to, which you expect them to use, then that is what behavioral finance is talking about. So behavioral finance is a study on how investors use emotions to take investment decision. Emotions, social factors. So this part of finance is looking at why do people make irrational decisions? We expect them to take rational decisions. Why do they take irrational decisions? And they do that because of several biases, which is what we're going to cover now in these videos. So I'm going to talk about all the biases. I'll tell you their meanings and give you an example just to help you in your studies, because this can be tested easily in your 2-3 marks questions. So what are those biases that make investors take irrational decisions? So the first one I'm going to look at is the confirmation bias. Remember, we are looking at behaviors that are contrary to logic, that are contrary to rational behavior. So this is almost saying that people are taking decisions without information that is empirical, without fundamental data, without ratios, without analysis. They're just using their mind, their emotions, their beliefs. So that's what we're looking at. And there are different types of such beliefs. The first one is confirmation bias. So for confirmation bias, what we're saying is that investor tends to look for information that will confirm their personal belief. So they already have a belief. So they're only looking for information that support that belief. So any information that doesn't support that belief, they are quick to just push it aside. They don't pay attention. They won't look at it. So it's more about their personal interest, about what they believe. So it's a selective attention, in quotes, put it like that. So what I'm saying is that investors are only interested in information that is consistent that is consistent with their existing belief. That's it. So they ignore contrary information. So that's why I call it selective attention. So they don't pay attention to anything that is contrary. They only pay attention to things that are consistent with what they initially believe. And a typical example would be when you have an investor that believes that a particular stock should be going up. That kind of investor will only be looking for good news, because only good news that will make share price to be going up. So if it sees a bad news about that particular stock, that investor will be quick to push it aside and will not read it, will not even dig deeper, right? So an example is a bullish. Remember, bullish investors are investors that believe that share price will go up. So an example is a bullish investor who will read only good news about the stock, or will pay attention only to good news about a stock, but what ignores the bad news. Because in his mind, he already has the mindset that that particular stock will be going up, and he's bullish about it. That's one. Another one is what we call anchoring. This is another bias. Anchoring. And from the word anchor, what we're saying here is an investor that will be stuck on initial information. So even when a new information is coming, he's not paying attention to it, because he had initial information, and that initial information is what is anchoring on. So any decision that he wants to take is based on that initial information, the original information. Even if new things have happened, new information is available, he's not looking into that. So we're saying an investor is getting stuck on initial information. On initial information. Yeah, when making new decision. You're about to take a decision whether to buy a share now or not. You're not looking at the current information. You want to sell a share, you're not looking at the current information. You're just focused on the original information you have. So another way to think about it is to say this is a starting point hook. So you're only focusing on your starting point, your original point. Yeah. Yeah, and a typical example is when you buy a share. Say you buy a share for $10. Then while you are holding that particular share, the share price starts to go down. Probably bad news comes out about the company. So a share that you bought for $10 all of a sudden starts to go down to even $5, $7. Then you say, no, you are not going to sell, because you believe that the share price will come back and will still rise beyond the $10 entry point, your cost price. So you are anchoring on that original point of entry, which is your $10. Yeah, and that is anchoring. Yeah. I think at this point, I also mentioned to you that some of these behaviors can be linked to other behaviors. Yeah, because what I just described to you also can be similar to, loss aversion. So it's possible to have a scenario that you can actually describe as exhibiting two different types of behavior. Right. So to put it down an example, so let's say the initial information is the cost price of these shares. Yeah. So initial info of stock. Yeah. It's $10. Yeah. So investor has refused to sell below $10. Yeah? Why? Because he has a belief that the price will rise, will go beyond $10. So he's waiting for it to rise above the initial price of $10 before he can sell. So he's anchoring on that original information. The investor is anchoring on the original price, the initial price. And that is anchoring. Talking another one about conservatism. Conservatism. Conservatism, very simple. This one is just when an investor is very reluctant to change. Reluctant to change, even when there is new information available. So despite reluctant to change your belief, let me put it in detail so you can get it. Reluctant to change one's belief despite new information. Yeah. So you have a portfolio of different stocks and companies, and you're getting information that a particular company is not doing well. The normal thing you should do is to sell that particular stock out of your portfolio because you don't want it to get even worse. However, if you're a conservatism biased person, you will not want to change your portfolio structure. So you want to stick to it. In that case, you are holding on to what you should not be holding on just because you are being conservative. Yeah, so like I said, an example is not changing your asset allocation. Yeah. Not changing an asset allocation. Asset allocation is about the component of your asset in your portfolio. Asset allocation despite bad information, bad info about some stocks in your portfolio. Yeah. So that is conservatism. You don't want to change your belief. You are very conservative. Yeah. Conservatism, that's it. Very straightforward and direct. Moving to the next one is the mental accounting. Mental accounting. This one is funny because we all exhibit this. And this is when you treat money based on the source. So this is about treating money based on its source. You know, there are different ways of getting money. It might be a gift, it might be your salary, it might be your bonus. So sometimes we believe that when we work hard for money, we spend a lot of time thinking and planning how to spend that money judiciously. You're very careful. Whereas if it is a gift or a bonus, some people or some of us, we care less about how we want to spend it. You see, when you just carelessly spend the money, you don't care, you can buy whatever you want to buy. You're not thinking about the return. You just want to spend the way you like because it's almost like a free money. Money is money, and you should not do mental accounting. You should have a one principle of spending your money. So it's funny, but it's actually the reality. So this is about careless. Example is when you do a careless spending. You're not doing so much research on where you want to put the money and what you want to do with the money because you believe it's a bonus. So careless spending of gift, cash, or bonus. Yeah. Whereas you're very careful when you're spending your salary because hard-earned money. So, but carefully planning how to spend salary because you work so hard for that one. So you believe that's the only part of money you should be careful. No, you should be careful with everything, all the money. That's mental accounting. Another one is loss aversion. I touched on this one briefly earlier on. Yeah. So this is when someone feels so much pain with 10% of loss than 10% of gain. So normally you will expect that if you make 10% of gain, the same way you are happy should be the same way you will be unhappy when you make 10% of loss. That is what you will expect. However, if someone is exhibiting this loss aversion, they feel so sad, so horrible when they are making loss. But the same amount of gain, they are just okay. They are not super excited as you will expect, right? And that is why you see someone that will be selling gain too early, yeah, because they made profit and they just feel like it's okay, we'll move on. But when it is a loss, they feel so sad that they are holding on to it. They can't bear it. They just don't want it to crystallize. So they will hold on to that shares until they believe that it will come up. It might come up, it might not come up. Or it might take forever to come up, which if you had sold it, minimize your loss, you could have invested in something else. And even probably you would have made so much profit, times 4, times 5 of what you have been holding on, right? So this is when investor does not want to accept a loss. They don't want loss to crystallize, right? So more pain. So you feel more pain on a loss, but less joy. Let me put it like that. On same amount of gain. Yeah, that's to put it in a simple way. Yeah, and what do you see? Investor is selling gains too early because they don't even want it to go into a loss position at all. So they quickly realize the gain so that they will know that, oh, this is a gain. So you sell gain too early. But once it drops into a loss position, you cannot sell because it doesn't want to realize the loss. Because, if you sell a share that's in a loss position, you have realized the loss and that loss has crystallized. But when you are holding on to loss position, hold loss position for too long, it might even get even worse. So all these are indications of loss aversion. Another way to see it is what we call, that is called your disposition effect. Selling gains too early, holding loss for too long. You shouldn't do that. That's a disposition effect, and no investor should be exhibiting that. However, is the reality, we do it. So an example is when an investor say, I will sell the stock when it increases above my cost price. So even if bad news keep coming in about the company, you've seen that this company is almost going into bankruptcy, which means you might lose everything. This investor will still not sell. He will still be believing that it will rise. But that's emotion. That is not logic. That is not data. And you can see everything we've been dealing with, no data. They are all just random behaviors, right? Another one which is very popular is overconfidence. That's another bias. Overconfidence bias. Here, that's when people think they are better than others. So when you think that you are better than other investors, so you're saying that you can pick a better stock than others. You know when to sell, you know when to buy, better than others. So you think you are better than others. Or you even overestimate your capacity. So you overestimate your capacity. So what we're saying is not that we're saying that you are poor or you are bad. You are good. However, what we're saying is that you think you are better than you actually are. And if that is the situation, you will be underestimating risk. That's what we're saying. So you underestimate risk. You're not able to dig deep as should actually dig deep into. Once you see a little information, you can just think you are smart and that information is enough, then you take your decision. No. If you do that, that will lead you to overtrading. And which means you are doing more than you should. Yeah, you are using limited information to decide. You're not spending time to do a thorough research. Yeah. And an example is when an investor believes that you can always make profit. Yeah. So you are looking at a stock and you think, oh, you know what to do. You can always make profit from this stock, whether you are short selling or you are going long on the stock or whatever. You know what to do. You're not paying attention to the information available. You're not doing analysis. You're not checking fundamentals. You're not doing technical analysis. You're not doing anything. You just believe you know it all. That is overconfidence. Another behavior is herding. Herding is another one, which is just people copying the crowd. So when you go with the crowd, you're not doing your own assessment. Yes, you're going with the crowd without individual analysis. You're not doing any analysis. You just discover that everybody is buying the stock, and you decide to go and buy the stock. Yeah, so when you buy a stock, buying a stock because a lot of people are buying it. If you're buying just because of that, you're exhibiting herding behavior, and that is not the best. You're creating a problem for yourself. Still more to cover. I want to cover as many as possible so that you will not see anyone that you think you have not heard of before. And that is gambler's fallacy. That's the next one I'm talking about. Yeah, gambler's fallacy is when an investor expects a future event because of another random past event. No analysis, no data. You just expect that a future event will happen because of a random past event. It's random because it's not data. It's just you're just using any information in the past to hook your decision on to say, yeah, take for instance, the share price has been going down the whole of last week. So share price going down for past week, and you say, oh, because of that, in your mind, you believe that this week it will go up. You expect the price to go up. No. You can see that there is no logic there. There is no analysis. There is nothing technical, no fundamentals. You have just based your decision on random events. You don't even know why the share price was going down last week. Maybe the company is collapsing and everybody is selling, which means it will keep going down. But instead of you to act based on that, you decided to act contrary, thinking, yeah, things will turn around without any data. So we are not using fundamental. Next is hindsight bias. Hindsight. And you see from the word itself, hindsight, about the past. Yeah, so this is a behavior when an investor believes that event could have been predicted. Simple. So when something has happened, and because of the benefit of hindsight, you just believe that, oh, I could have predicted this one. We knew this will happen. But before it happened, you did not predict it. But it's very easy for you to say, no. I could imagine, yeah, we were expecting this to happen actually. I think I just kept quiet. No. And that's why sometimes the hindsight bias leads to overconfidence. Because the next thing you now start thinking you can predict the next thing that will happen. So it's very interesting topic. So this is a belief that event could have been predicted. When we know definitely that stock market is highly unpredictable. Yeah. Like I said, this can actually lead to overconfidence bias. Have overconfidence. Yeah. So an example is when an investor says, I knew this will happen. Yeah. When you hear an investor saying that, it's exhibiting hindsight bias. So when an investor says, I knew the stock markets or the share price of a company, yeah, well, maybe the price of a share would crash after it has actually crashed, not before. So because it's hindsight, that is a bias. It is not based on fundamentals. Because why didn't you tell us before it happened? Next, I'm going to be touching on is availability bias. A lot of interesting biases. Availability bias. Yeah, and here you see an investor attaching so much value to information just because they are readily available. Simple. So when an investor attaches so much, when you attach so much value, yeah, which means you believe it so much, and you're acting based on that value to information because they are readily available. And you can reckon with this. The most readily available information is news. Wherever you are sitting, news will just come to you. You don't even need to search for them. Yeah, there are news that you have to search for, but there are news that will just come to you naturally. So if you are acting based on those news that just naturally comes to you, you are exhibiting availability bias. Yeah, so an example is when investor considers only news without effort to dig deeper or do analysis. Because even when you get some news, you probably still need to do some analysis, calculate some ratios, look for more information before you take decision. That is rational behavior. But when you don't do that and you're just focusing on available information without asking whether they are even true or not, whether there are even more contrary information you can find. You are not searching. You just focus on what is readily available to you. Then that is availability bias. The last one I'm going to be touching on, very funny one again, is the recency bias. Recency bias is when you take decision based on the recent experience, based on the recent happenings around you. In fact, a typical example is, think about this. Look at the aviation industry. You know that, transportation by air, flight is still the safest, very safe. Compared with the number of flights that travels in a day and the number of accidents you will see, you realize that it's quite very safe. But if you probably hear news recently about plane crash, or maybe it even happens close to you that you even saw it around you, you will discover that there are people that will probably have a flight the next week or a few days after, but they will cancel their flight. They are afraid. Or even when they fly and they are in that plane, just a little turbulence, they are shaking and they are praying and they are, almost thinking their plane will crash. Of which, if they did not know about any news about plane crash, they would not even feel any different. So all of a sudden, the recent event, the crash event, has changed your mind and you're thinking like aviation flight has now become very unsafe. So that is not logic. Logic is that it remains the safest way of flying. It's very safe. But the recent event has beclouded your mind and you're thinking you are not safe. So that is recency bias. So this is when an investor expects recent events to reoccur. Yeah? When you expect a recent event to occur. Yeah? And therefore, that will affect your decision because you want to avoid or do it, depending on the nature of the recent event. Yeah, it will affect your decision. If it's a good recent event, you want to do it again because I think it will happen. That's when you see someone buying a stock. He buys the stock has gone up, he sells it, makes money, he's happy. Then the next thing you see him buying that stock again, thinking it's still going to go up. Then guess what? The stock starts to come down. Then you lose money because you've not traded based on logic. You've not traded based on fundamentals. You have only been trading on bias. And that's why a lot of people actually lose money in stock market. Yeah. So here you can also, an example is also maybe you are not investing in stock because the price has been going down or because of recent market crash. You believe that no, I'm not buying stock again because of market crash. It's always a cycle. There is up and down, but you don't want to believe that. You're just anchoring on your recent information, the recent experience. So this is not investing in a company share just because the price has been going down. You are not checking why it's been going down. Yeah, you just feel like because it's going down, I'm not buying it. So those are behaviors that necessary to understand. You must understand them, you must know them.